The COVID-19 pandemic disrupted life in many ways, including forcing people to slow down and assess what really matters to them, particularly in terms of how they live and where they live. Globally, there's been a mass exodus from dense urban areas to more spacious suburbs, and as a result, the residential housing market has been steadily climbing since early 2020. In the US, pricing has seen an overall increase of around 15%, and demand has never been hotter. But can the demand for homes meet the current supply? My name is Anu Rajakumar, and with me today is Dmitry Gasinsky, Head of Residential Loans at Neuberger Berman, to share more about today's housing market and more. Dmitry, thank you for joining me today.
Thanks for having me.
So now, Dmitry, I'm based in the New York City area, and certainly from my own personal experience, I've seen that it really seems like a seller's market for the last 12 months or so, particularly in the suburbs with close proximity to major cities. But could you share a bit with us about what's been happening in the residential loan space and also what's changed in the landscape over the course of the pandemic?
Well, I think you're exactly right. Residential housing and as a consequence, residential housing credit, which is our focus, has been exceptionally strong for quite some time now. So strong, in fact, to your point, and I'm sure we've all seen the headlines, that in some geographies, buyers have been frustrated by how difficult it is to buy a home with rising prices and rising competition. In our view, this is nothing new, of course. Powerful long-term dynamics have been contributing to this and can be traced back, I would say, at least a decade. And I'm certainly happy to expand on the history, but even before COVID, national home prices had been up over 62% over the prior decade. More than $12 trillion of net additional home equity had been created. Having said that, to your point, COVID certainly played a role in the more recent acceleration of home prices. Nationally, as you mentioned, housing prices are up nearly 15% over the past 12 months. And this is largely consistent across all major geographic regions. One post-pandemic dynamic contributing to this is lower mortgage rates. We're about 75 basis points lower today compared to pre-COVID. And of course, what that means is that at the same price point, this would translate into an 8 to 10% lower monthly payment for homeowners. So clearly, lower rates is a positive for home prices. Another interesting pandemic-related development has been the rise of work from home and also deurbanization, mobility, and relocation trends. People are certainly investing more in their homes today. In and of itself, this is a positive for home prices and housing fundamentals. From the investment opportunity standpoint, we've seen increased demand for home development and renovation finance, which we see as a very attractive, higher yielding, high credit quality lending segment. Additionally, and no one is surprised by this, at the height of the pandemic, with all the lockdowns, the usual appeal of urban living was waning, and people's housing preferences shifted somewhat toward less densely populated suburban areas. And this has been showing up in the numbers as well. The differential in price growth between more densely populated urban areas and less densely populated suburban areas have been about 10 points. So downtown areas are up in price by 10% less. And not surprisingly, it's the cities with higher population density and higher income levels that ended up losing more people. So essentially, if you could afford to move, you were more likely to move. New York, Los Angeles, San Francisco, San Jose are some examples. On the flip side, other areas seem to have benefited from this trend. Jacksonville, Albuquerque, Memphis. So the bottom line is that virtually all housing segments are doing well fundamentally. But the suburbs are doing better. Single-family housing is doing better. Smaller metros are doing better. Back to your original point, Anu, residential housing remains exceptionally attractive. Private lending environment in residential space is exceptionally attractive. And the pandemic did not cause, but certainly accelerated some of these positive fundamental trends.
Yeah, thank you. That's a good overview, and important to note that this wasn't just initiated by the pandemic, but something that was sort of happening pre-COVID as well. Going back to the opening, I mentioned supply demand. Tell us about how that picture looks today, and what are some of the associated factors that are shifting how the housing market's looking?
Yes. So I promised to elaborate a bit on history, so this may be a good opportunity. So just to give you a bit of a backdrop, for several years after the 08-09 crisis, macroeconomic conditions remained very challenging. We were in a recession. Housing credit conditions remained extraordinarily tight, both for home buyers and home builders and developers. The regulatory conditions remained in flux. It was tough to get a mortgage. It was tough to buy. It was tough to build. And consequently, for quite some time, housing activity of all kinds had remained, if not non-existent, then certainly very much depressed. As a result, now, several years later, the economy is very healthy, and we have an environment with all this pent-up demand from new families coming online, from families who delayed buying a home for a few years. And at the same time, after years of underbuilding, we have a severe shortage of quality homes that people actually want to buy. Housing inventory levels are as low as they have been in over 45 years. And much of this existing inventory is old. And today's buyers want turnkey, open floor plans, modern designs, Wi-Fi availability. There's not nearly enough of this product on the market. All of this will need to be built. All of this will need to be developed and renovated. Incidentally, as I mentioned earlier, this is why we're so constructive on the residential development finance as a lending segment. There's not enough private capital in the space, not enough lending expertise, and very strong demand for credit from highly experienced, well-capitalized residential developers. So a very attractive opportunity to lend on a short duration basis at attractive rates to high-quality borrowers. There's actually an additional wrinkle to this added by demographics. First, people are living longer, which of course is wonderful, but it does add additional fuel to housing demand. And second, age groups that happen to be most prone to buy homes are expected to grow at a rate faster than other age groups going forward, which is also a demand positive. So the bottom line is this. We've had this confluence of accelerating demand and essentially non-existent supply. And of course, as in any other market, when you have too much demand and not enough supply, prices tend to go up. COVID is playing a role, but in our view, it is much bigger than COVID alone.
Yes, thank you very much for that, Dmitry. Now, as we know, housing prices across the country are, through the roof, no pun intended. How do you respond to people who are worried that this is another bubble, something like what we saw in the lead up to the global financial crisis? What are the similarities or differences that you see between today's housing market and what it looked like in 2007, early 2008? What are you seeing in terms of those market trends?
Well, I think this is an excellent question. And I think the differences between today's housing environment and what was going on back in 07, 08 could not be more stark. We, as investors, focus on private residential loans, private lending. And so one of the most direct differences impacting our markets is private capital participation in residential mortgage finance. Prior to 2008, private capital played a very significant role in housing finance, being upwards of 15 to 20%. But since 2008, private capital essentially vanished and is only gradually beginning to reemerge. It's at about 3 to 4% of the landscape today. At the same time, lending infrastructure, private lending expertise, research, management capabilities, operational infrastructure, all of those things essentially vanished after 08. So what was going on back in 07, 08 that ultimately caused the crisis? Well, there was a number of factors. First, oversupply of housing. There was a massive overbuilding fueled by loose and expensive credit and massive amounts of liquidity in the system. That led to weak credit characteristics, overlending, including prevalence of no money down loans, as some of us may recall, proliferation of fraudulent practices, unaffordable loan products, loose regulatory framework, loose regulatory oversight. And ultimately, all of these things in combination resulted in a housing bubble and resulted in a 40% or so housing price declines. Now, contrast that to where we are today. As I mentioned earlier, non-agency mortgages right now represent a fraction of what they once were before 2008. I mentioned that roughly 12 trillion of additional home equity had been created over the past decade. At the very same time as all this home value was being created, there was virtually no new net debt being added to the system. So what we've seen is a massive deleveraging in housing finance post-08. And of course, in and of itself, that's a very strong fundamental trend. What we're also seeing is much better, much stronger credit characteristics in today's lending environment, much more favorable housing fundamentals, and importantly, a well-defined, strong regulatory framework introduced in 2014 by the Dodd-Frank legislation. One of the most important features of that legislation was the introduction of the so-called ability to repay rule. It sounds pretty self-explanatory, pretty self-evident. But essentially what that means is that every mortgage lender today is obligated to take reasonable steps to ensure that if they make a loan, the borrower has the reasonable ability to repay that loan. And that, of course, adds pretty meaningful credit guardrails to ensure credit quality of the system remains strong. And of course, what also has been happening today, particularly post-COVID, is this massive and unprecedented help coming from the government and the Federal Reserve Bank to support consumers, to support the housing sector, the financial sector, mortgage servicers, and mortgage lenders. Of course, all of these things in combination make, as I mentioned, the picture very different today. It's a vastly different set of circumstances. In summary, I would say this. The credit environment is very different today. Credit standards are a lot stronger. Housing fundamentals driven by supply and demand dynamics are a lot more favorable. And importantly, the government regulatory framework is a lot stronger and well-defined today.
Yeah, perfect. Thank you for answering that very comprehensively. I think that's very important to compare and contrast those two very different and important time periods. I just want to touch upon something that you spoke about at the end of your comments there about policy. There's been huge amounts of stimulus around the globe, and would like for you to just dig in a little bit deeper about the current credit landscape that you're seeing here in the US and how that affects the overall housing market. You know, we talked a little bit about mortgage rates going down. I know lots of people have refinanced in the last year as well. Could you just expand upon that a bit?
Well, clearly, government policy has always played an important role in residential mortgage finance. A large portion of the consumer mortgage market is ultimately guaranteed by the government prior to being sold to investors. So naturally, what the government decides to guarantee in what fashion very much impacts where and how, in turn, private capital can participate and find value. This is something that we as private investors pay very close attention to, and it certainly impacts our opportunity set. A good recent example of that is a decision by the government agencies to limit the amount of non-owner-occupied or investor property loans they guarantee, which is likely to increase non-government capital participation in that segment of the market in particular. And though there are other direct and indirect ways that government policy plays a role. Certainly, this was particularly evident last year, to your point, at the height of the COVID disruption, when the government injected unprecedented amounts of fiscal and monetary stimulus to prop up consumers and businesses. This was extremely effective and essentially helped ensure that COVID ended up being a non-event from the credit standpoint. And of course, we also ended up with much lower mortgage rates due to substantial monetary stimulus coming from the Fed. And of course, all this liquidity coming into the system is likely to create some inflationary pressures in our view and boost demand, including consumer demand for housing, which we think is a net positive for the housing market.
Terrific. Thank you. You know, as we wrap up here, Dmitry, I would just like to get your thoughts on, where do we go from here? Personally, I'm team New York's coming back. I don't know what your view is on cities. Do you see deurbanization as an ongoing trend? Do you think the landscape's going to change and moderate? Would love to get your thoughts on that.
Yeah, well, look, I think the jury is still out, to be perfectly honest. To be fair, it remains to be seen how much of this post-COVID landscape will become permanent versus ultimately being transient in nature. My personal view, and I agree with you entirely, the city is not going anywhere. It's been a part of human social evolution for thousands of years, and it's unlikely that 1 year pandemic will somehow irreparably tarnish it. So you can probably tell I'm also a fan. Having said that, we're also likely to see a continuation of robust demand for single-family living, whether in urban or suburban areas. Price appreciation trends are more likely to moderate, and the gap between more and less densely populated areas that has been growing more recently is likely to close over time. But more broadly, the punchline, if you will, is this. Residential credit and private lending environment today is as attractive as it's been in decades. I hardly recall an environment as fundamentally favorable as it is today. We expect very robust housing activity in the coming months. Home purchase activity is certainly picking up. Single-family rental demand is growing. Building and development activities of all kinds are picking up. And all of our key lending segments in virtually all relevant geographies are growing. Housing fundamentals are as strong as they've been in decades. So we're very constructive on our markets in 2022 and beyond.
Excellent. Thank you very much, Dmitry. Now, for the bonus question in today's episode, I would like for you to please describe your dream house. If you could live in any other home anywhere in the world, describe that property and where it would be located.
Oh boy, that is a tough question. Well, as I mentioned, I have been a city dweller for pretty much my entire life, so that's where my heart is. I like living in densely populated downtown areas. So I suspect that my dream house is not a house; it's more likely an apartment somewhere in the 87th floor of some tower overlooking some body of water somewhere in the world. But I do like to travel. I like to see, other places, meet other people. So to the extent possible, if I'm ever in a position to own multiple homes, I think that's something that I would very much enjoy as well, just to have an ability to spend time in other places around the world.
That is very fair. I was going to say, just south of Central Park, there are some beautiful, new, huge buildings that have a great view of the reservoir right in the middle of Manhattan. So something to consider. All right. Well, thank you, Dmitry, so much. That's going to do it for this episode. Really appreciate the insights on an area of the investment world that is so important and close to home to many. Very intrigued to see what's ahead for the housing market. But again, Dmitry, thank you very much for joining us today.
Thanks very much, Anu, as well. It's been a pleasure being here.
And to our listeners, if you like what you've heard today, you can subscribe to the show via Apple Podcast, Google Podcast, or Spotify, or you can visit our website, www.nb.com/disruptive forces, for more information about our firm and offerings.
This podcast contains general market commentary, general investment education, and general information about Neuberger Berman. It is for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. This communication is not directed at any investor or category of investors, and should not be regarded as investment advice or a suggestion to engage in or refrain from any investment-related course of action. All information is current as of the date of recording, and is subject to change without notice. Any views or opinions expressed may not reflect those of the firm as a whole. This material may include estimates, outlooks, projections, and other forward-looking statements. Due to a variety of factors, actual events or market behavior may differ significantly from any views expressed. Please refer to the disclosures contained in the episode notes and episode details, which are an important part of this communication. Investing entails risks, including the possible loss of principal. Past performance is no guarantee of future results.